Hello, everyone. Thank you so much for joining us for today's webinar. I am Rachel O with Peg Capital Partners.
And I'm Allie Monson. And as you can see, this is not the typical view from our headquarters in Provo, Utah. We actually, for today's webinar, decided to hit the road, and we are on the site of a 12-acre property in Spanish Fork, Utah, about 50 minutes south of Salt Lake City, that within just a few short years will likely be home to one of the first build-for-rent communities here in the Mountain West. Now, we are in a field, really. I mean, this is a very, very amazing site that I think will make for a great property for this product type. There are some horses, so please excuse.
You see them, don't be alarmed.
Duke and Daisy may make a guest appearance, but just disregard. We thought it was worth it to be able to show you the incredible property.
Absolutely. And with demographic shifts, the constrained housing market, and rising construction costs, the decline in home ownership affordability is one of the most pressing challenges facing many Americans, driving additional demand toward low-density rental housing. The COVID-19 pandemic has also created financial hardships for millions of American households, and many may remain in the rental housing market for a more extended period of time. All these factors contributing to the rapid growth of a new rental housing product type, build for rent, which to date has been highly successful in other markets. And we at PEG are now focusing on bringing that product type here to the Mountain West.
So exciting. And you know, there's opportunity everywhere right now, but if you take a look at what's playing out specifically in the Mountain West over the last decade, you'll quickly see why we believe focusing on this region is highly compelling. Right now, we are seeing a modern day rush to the Mountain West. So for those who may be familiar with our pioneer history here in Utah, you'll recall those early settlers who first made that long trek here 175 years ago. Well, fast forward to today, and for a variety of different reasons, including population growth, both before and during COVID-19, diverse job opportunities, our incredible outdoor recreation, strong growing economies, and favorable business environments, people are once again declaring that, yeah, this is the place where they want to be. And as they continue pouring into this region, they're creating some really exciting opportunities for commercial real estate investors.
So we have a great lineup of speakers who will bring a diverse set of expertise and perspective to the conversation. And we'd like to start with our very own Chief Investment Officer, Soren Halliday. Soren, let's start with the basics. What exactly is this build for rent, and what does the strategy entail?
You know, Rachel, build for rent can really mean a lot of different things for a lot of different people. For us here at PEG, it's taking the advantages of the traditional multifamily product and incorporating that across a spectrum of single-family product, meaning townhomes, patio homes, or even for-rent single-family detached product that's very similar to for-sale product that we see in the marketplace. So it's just like taking a stacked flat vertical apartment community and making it all horizontal. The residents are basically renting a home, but they're in a community enjoying resort-like amenities, such as a nice clubhouse, a nice grassy area, a nice pool area, barbecue area, fire pits, all wonderful amenities. But the best amenity is the fact that nobody's living above them and nobody's living below them. So why are we moving into this strategy? Several reasons. The first one is renter demand. We're seeing a strong movement towards this product. Single level living, small yards, solid amenity features. You don't have someone above you or below you. If they're patio homes, you mostly have 4 walls that are your own, which includes a lot more window space, light. People also enjoy the flexibility of renting. Another factor, affordability. It's becoming a lot more expensive for people to buy homes. Another factor is the Mountain West area. But here in the Mountain West, we're seeing that nobody is really rolling out this program in a systematic way like we want to do. But we are super excited to be pioneering this effort here in the Mountain West, where we don't see many groups doing that. Let me show you some data that gets me really excited about this product. So we live in a supply-constrained market. So historically, about 1.5 million homes were built a year until really the great financial crisis that began around 2006. At that point, you can see we saw an extreme drop-off of development that created a shortage of homes of about 5.5 million units. Today, you can see the lack of homes that are on the market, coupled with the continued decrease in the number of days these homes are on the market. This makes it really difficult to buy a home. And if you've been on the market out looking for houses, you know what I'm talking about. take a look at this. Look at how home prices have shot up over the last few years. US median home prices have gone up about 36% over the last 5 years. But look at these Mountain West areas. You're averaging over 60%. That's nearly double the US average. Take a look at Boise, almost 100%. And look at just the past year alone, almost a 30% increase. We ran these figures a few months ago, and if I were to rerun these figures today, I'm sure the numbers would be even higher. People are struggling to afford homes right now. What's their best alternative? Renting. On this next slide, we're seeing what we believe is potentially a permanent shift of remote versus in-office workers. Pre-COVID, there weren't very many remote workers. Post-COVID, obviously that changed. We think that there's continued chance in the future that this change is going to be permanent. So on this next slide, we're also seeing renters desire slightly bigger living spaces, yards of some sort, and all the features of a build-to-rent product, like 4 walls, amenities, nobody living above them or below them. Even though the patio homes really aren't much bigger than apartments, the yard and added window light makes the small home feel that much bigger. And lastly, we're seeing a greater number of people across multiple generations preferring to rent. Millennials, Gen X, and baby boomers, they're all shifting their desires. They're okay renting, and they're actually preferring to do so. So whether it's because of affordability, convenience, flexibility, or they're in transition to find a home, it's becoming quite a bit more popular way to live. So in summary, the timing is right. The lack of for sale product, affordability challenges, the increased demand to rent, and rent specifically this type of product, we're ready to pioneer this product into the Mountain West.
Thanks, Soren, for the information you've presented. It's all very compelling, and it also brings to light some very practical realities for today's renters.
For sure. I really like, what Soren said about this strategy appealing to every single generation. Millennials, for example, you take a look at that demographic, that group, and really they're hitting that age in their late 20s and 30s right now when they want their own space. But a significant portion of millennials are dealing with a lot of debt. I mean, earlier this year, educationdata.org published their latest numbers, which show there are nearly 15 million millennials right now across the country who are paying off student loan debt specifically with an average balance of 38 grand plus per borrower. And that's significant.
No, that is crazy. And I mean, you look at Utah, and it used to be that millennials or this millennial age demographic could graduate. They tended to get married young. It's kind of the way it is here. But they could quickly buy into a home. And then they could start their life, and then they could build sort of their home wealth from there.
Get that starter home under their belt.
Very, very common. I came from LA, not common there, but It was definitely common here. And then the other interesting thing too, you've got groups like baby boomers. They actually don't necessarily want to be tethered to a region anymore. So they want to be more mobile. And so, they're kind of flitting from region to region. They maybe have sold a home and they're kind of living off of that plus their retirement. And they don't want to deal with a mortgage.
Yeah, they don't want to be tied to that.
Yeah, so it's really interesting how things have changed over the years.
It really has. And Rachel, interestingly enough, RCLCO just recently published that joint study with ULI around this very subject of rising renter demand across the country.
Yes, and we're excited to turn it over to Adam Decker, CEO of RCLCO, to share some of the insights from that study. And Adam, if the soaring home prices here in this region aren't an indicator of current and future renter demand, I don't know what is.
That's exactly right. Although we're talking about growth, it's worth noting that this is not a new phenomenon, right? Of the 137 million housing units in the United States and of the 45 million that are occupied by renters, 15 million of them, more than a third of the rental household units in the United States are in fact single family units, right? This is nothing new. Rather, this is an opportunity to professionalize, to provide the kind of sophistication and professional market management that we see in the apartment market to the 15 million households in America and throughout the Mountain West that already rent their homes. Today, the vast majority of those homes are owned by mom and pop. The idea here is to serve this very large, very fast growing, very much price and economically stressed market with high quality, professionally managed housing appropriate to the growing families of the region and of the United States overall.
So Adam, what are the characteristics of the areas where you've seen this product type be most successful?
It's a good question. We see very high-end, urban infill, quirky townhome projects. I'm talking like $4,000 and $5,000 a month, and not just in high-cost coastal markets. In Denver and other places around the region. To the other extreme, which is we see much more value-oriented product, lower density on the really suburban fringe, and then everything in between, right? So what's so exciting for a group like PEG is the opportunity to invest in different product solutions that match the demographics of that market. It's very much different than, this type of single family for sale works only here, or these type of apartments work only in the urban core. It's a much more fluid market. And really what that means is that the creative developer with, the right capital strategy can be extremely nimble and thoughtful in responding to the market opportunity.
So Adam, can we talk about the return profile for a second about these build for rent investments? I mean, why are groups investing in this space?
We believe that real estate in general, and for sure housing, is about income investing. And the pattern that for rent housing has had of very, very stable returns, the ability to always manage to pretty close to full occupancy, and just the consistent rate of income growth makes it the perfect real estate investment. Not to say that every quarter is terrific, right? There are bumps in the road, but when we look over the last 20, 30 years, the predictability, the stability, the growth in income that rental housing has produced is second to none. And over the next decade, we think that, given the undersupply of family appropriate housing in the United States, the durability, the growth in that income will be really, really compelling.
Thanks, Adam. Here at PEG, the geographies that we continue to see demonstrating strong economies year over year are those across the Mountain West. When you look at indicators such as lower unemployment rates, rapid population growth, job growth, and GDP, Utah, Arizona, Idaho, and Colorado definitely stand out to us. And that's where we're focusing with our primary markets in this strategy.
Don Walker with the John Burns Real Estate Consulting Group is a true expert in the BFR space who has conducted dozens of studies into markets across the United States. And Don, when you take a look at the BFR opportunity that we at PEG are sort of systematizing on a larger scale here in the Mountain West for the first time, what are your initial thoughts about the potential demand for a product like this here?
Well, the research shows that there's strong demand for built rent single-family rental housing in the Mountain West region. And what I'm going to focus on today is it's built for rent, but what we call it is horizontal apartments. And there's really 4 different product types that we see most often in the markets. Horizontal apartments, townhomes, traditional single-family detached, and then there's another category that we put into the luxury category, really nice, large homes. So with the horizontal apartments, it has been one of the best performing products in the built for rent space. In the table that I'm showing now, the typical absorption or the average absorption for a horizontal apartment community is 18 units per month. It ranges from 10 to 30. I've seen as high as 40, and they're doing very well. The average occupancy rate right now is 98%, and that's out of 71 communities in our database. So there are opportunities and challenges associated with the horizontal apartments. The first is it is a really proven concept. As you saw in the prior slide, it's got one of the fastest absorption rates among all the different BFR product types. And it's an easy transition from apartments for those wanting privacy. People really like the fact that they don't have somebody living above them or below them, and they get a private yard for doing a barbecue or for letting their pets out to get some sunshine. But the yards don't need to be huge. They're 8 to 12 feet. And relative to investor demand, been very popular. Horizontal apartment sales represent about 50% of all the transactions we've recorded. And the cap rates have been very strong, 4 to 5%. And I've heard rumblings of one deal that could happen at under 4%. So very strong demand from renters and investors. And from a premium standpoint, these typically get, on average, about 20 to 26% premium above a typical garden-style apartment. I've seen some as low as 5% and some as high as 40%. Now, on the challenging side, they've only been proven in a few markets: Phoenix, Tucson, Denver, San Antonio, Austin, Dallas, Vegas, and Tampa. That doesn't mean they won't work in other places. They just haven't been tested there yet. Most of the units don't have garages, but Rachel and Allie, I know that PEG is considering adding attached garages to their built-for-rent homes as well. And so I think it's a great asset and another competitive advantage versus typical garden-style apartments. And the next slide I want to share is just our view on how strong the single-family rental market is across the country. So you can see there's no market in the country where we think it's going to be less than 1%. In fact, in the Mountain West states, and think of the big MSAs there like Denver, Salt Lake, Phoenix, and Las Vegas, we think in 2021 rent growth for single-family rental homes could be between 7 and 12%. It varies a little bit by market. And then slowing down a little bit, but still increasing in 2022 to around 4.5 to 6.5%. So frankly, very strong markets for single-family rental in general, and in particular in the Mountain West states. And the last slide I wanted to touch on is just how well single-family rental industry as a whole is doing. And we're currently at around 95% occupancy level, which is the highest in about 25 years. So the market for single-family rentals is very positive right now.
Don, why are so many institutional groups prioritizing BFR as a strategy? I mean, is this more than a temporary trend or a phase?
I think the investors are looking at single-family rental for the long run. Now, I don't think it's a phase. Single-family rental housing has been an important part of the housing stock in the United States for decades. There are 16 million single-family rental homes there. But right now, the institutional investors really began getting into the SFR space in 2011. And now they're transitioning into build for rent. And the reason is it's more efficient. Instead of trying to manage scattered homes around the country, you can now manage a neighborhood, a collection of 50 to 150 homes or more in one central location. So it's more efficient, it's new, so you're able to build these homes to what today's renters really want. So I think it's a trend that's here to stay. I don't think it's a fad. And one of the things that's driving it is single-family rental has proven to be very resilient during economic downturns or the shock that we just went through with the pandemic. Single-family rental occupancy rates, rent collections held up very well. And so it's the investors around the world have seen that single-family rental is a very resilient asset type.
So interesting. Thank you so much. Okay, so now that we have some insight into the market, let's take a deep dive into how these build-for-rent homes will actually look, shall we? As Soren previously mentioned, every community is going to look a little bit different based on the unique characteristics of the surrounding area and the specific details of the land site, including zoning, entitlements, size, and topography.
For more on PEG's build-for-rent strategy, we're going to toss it over now to David Bourne, recent hire of PEG, Vice President of Investments. He was brought in specifically to run the strategy for PEG. So Dave, let's get into the size. How big are these going to be and what are we looking at?
So Rachel, PEG's build-for-rent homes will be sized similar to traditional apartments. But it's everything else the residents receive that set us apart. With no neighbors above or below, our residents will be in more control of their space and thus their lives. This has become increasingly as important as, for many families, the home has become an extension of the office and, in some cases, the classrooms. The additional space and privacy features, such as fenced-in yards, will cater to the specific desires of those who are seeking this product. We've tried to visit communities like these all over the country to see what works and what doesn't work, and we've tried to incorporate the very best of what we have seen with the unique characteristics, though, of the Mountain West. We've created a specific brand for this product, and it's called Alante, which in Spanish means ahead. We're really trying to help our residents get ahead. Our experience has had an impact on how we created nearly every aspect of our communities, from the way we've laid out our floor plans to how we've incorporated windows and natural lighting into the homes, which is a lot easier when we're dealing with 4 separate walls as opposed to 4 shared walls that you would have in an apartment building. We are also including smart home amenities such as lights, alarms, and door locks into all of our homes, which will provide an additional level of comfort as well as a revenue source. All homes will have designated covered parking and available garages for an additional fee. All of these features are before we begin to address the community as a whole, which are being designed and laid out to enhance the appeal to our neighbors in the cities we'll be working with. Attractive designs, entry features, landscaping, and consistent maintenance have made it easier to work with cities and counties as we have been able to convince them and demonstrate that we'll be adding value for our neighbors. For the residents, they're going to enjoy resort-style amenities such as pools, cabanas, and clubhouses with private fitness centers, as well as dog parks, common lawns, and barbecues. Many residents will also come for just the safe and carefree lifestyle that Alante will provide. With gated access and hands-off yard and property maintenance, our communities will be attractive to a wide demographic. So getting back to the question about size, the standard Alante community will be between 10 and 20 acres and have between 100 to 300 homes. This size should provide a sense of community as well as economies of scale in our maintenance and the ability to spread out the costs of the amenities that we discussed. We've been fortunate to have already identified ideal sites in the Salt Lake City area, Phoenix, and Boise, including Spanish Fork, where you are today. And we're aggressively moving to get our communities out of the ground and open. We're all really excited about Alante, and we think our residents will be too.
I love these Alante communities, Dave. Sign me up for the first lease. I am there. It's everything you could want in one community. And really, there's nothing like it here in Utah.
You know, there really isn't. And with everything that's going on, with the economic growth, the pressures on housing affordability in the region, PEG is, we decided as part of our investment strategy to launch a fund specifically around this very build for rent. So we are embarking on PEG Capital Partners Fund 4. It's a $200 million fund. We're targeting approximately 15 to 17% net IRR to LP. It will be 8 years. However, each of the properties will be about a 3 to 7 year hold. So the idea is to build, stabilize, and sell. And we really do believe that we can achieve some better than average returns for our investors. And I just want to kind of point out, we're the only group in the region focusing on the Mountain West for this build for rent.
Well, and we are uniquely positioned to be able to execute on this strategy as well. With PEG's vertically integrated structure, we are quite unique. And that we have expertise in every single phase of this process.
And besides that, our founder and CEO, Cameron Gunter, recognized this strategy early on and has been instrumental in building out build for rent for PEG. So Cameron, what is the number one thing that groups out there trying to better understand this build for rent concept needs to know? Are there any misconceptions or elements of the strategy that folks really are underestimating?
Yeah, good question, Rachel. I was first introduced to this concept back in 2016 by a large multifamily contractor in Tucson, Arizona. He was actually the founder, one of the original investors in Avila Homes, and built Avila Homes. Now, we didn't end up doing the deal with Avila Homes But what we did learn from that early on is what the misconceptions are. And those misconceptions are that these are not single-family homes on single lots. They're actually single-family homes on one large lot like you would see in a multifamily housing community, and they need to be managed as such and developed as such. So what we feel like is if it's not managed like in a multifamily community where you have a sense of community and you have this resort-style living all in one with clubhouse and the amenities that are created there, that it's not as successful. So we feel like because of our experience in managing multifamily, that we can be successful. We also know how to do land entitlements. We find the right deals, and we can put a land deal together and the sourcing part of that. We also have the experience in development and construction of multifamily, which is a huge benefit for us as we've rolled our company up into one organization, more vertically integrated. And then lastly, with our vertical integration is our asset management ability and our investment management ability to be able to manage the investment once the investment is up and operating as a multifamily project. So from the deal sourcing to the ultimate disposal, vertically integrated teams who have in-house expertise in every phase of this process are those who are going to be the most successful. Having said all that, we're raising a fund. And so, Rachel, as we're wrapping up and as investors are looking for something, I would encourage them to reach out to you and get more information on this and the rest of our team to understand better what we're doing and how we can be successful in this investment.
Yes, thanks, Cameron. So feel free to reach out with those questions or drop them in the chat because we are now at that point in the webinar when we're ready to take some questions.
Yes, we are, and good timing as this wind is picking up here out here in Spanish Fork, but we're going to send it back into Soren Halliday, our CIO. He is standing by ready for those questions. And Soren, what are people asking?
All right. Thanks, Hallie. Let's get to some of these questions. So we only have a couple, so if anybody else has questions that they want to ask, please go ahead and do so. So we're going to start with Jared Giles, and his question is, traditional single-family rental has struggled with expense growth relative to apartments. Any thoughts on how PEG will manage operating expenses better / differently than peers? So Jared, based and kind of going off of what was discussed earlier about operating expenses and how these communities we are looking at building will be a little bit more efficient. Think of it like this. Again, I think I mentioned before, we're basically taking an apartment building and we're just spreading it across acreage. And so management in our mind is going to be very similar to operating an apartment building. If you have 100 units, you'll have 1 to 2 to 3 individuals on site managing the property. And we have a in-house property management company. So we're really excited about this. We think it fits in really well with our vertically integrated company aspect. So, really managing these properties is going to be very similar to managing an apartment property itself. So hopefully that helped answer your question. Benjamin Ling, what are some good source documents, studies that demonstrate the extent of the undersupply of family appropriate housing? So Benjamin, to answer this question, I'm going to rely on the companies that we actually had on this webinar. We had John Burns, Real Estate, Don, and we also had RCLCO with Adam. So those two companies have provided us very good instructional information. You can find that on the internet. You can actually call them up, and they're more than happy to talk with you and point you in the right direction. There's other information out there. ULI has done a great job of putting information about this type of product out on the marketplace. And then there's also some other good source documents that the government has put out on housing and what's going on in those trends. So if you have any other specific questions about that, we're happy to provide you that information and provide you some source documents that we have. A question from David Parker. Soren, what is the exit strategy? Selling off individual properties, trading into another fund? Great question. We get that question asked to us all the time. So the answer is, if you think about timing wise, we will be under construction on assets, let's say within the next year. You've got a couple years of construction and lease up. So we're seeing 3 years down the road, we would like to build 3 to 4 to 5 years down the road, we'd like to build a portfolio of these assets, whether it's 8 to 10 to 12 of these properties with this fund. And sell these as a portfolio or sell them as individual opportunities. Right now, we believe that there is significant capital looking at those two different opportunities in the marketplace, and we believe several years from now, the capital is going to be that much more educated. We're going to be that much more educated, and we're really excited from where that trend is heading. So we believe whether it's individual sales or portfolio sales, that those are options for us, and we believe that there's going to be significant capital in the marketplace looking for those two options. Greg Jackson, can you speak again to the potential monthly return? So another good question that we get asked quite often, Greg, is what are we underwriting to, right? So we see this as a very similar to traditional multifamily underwriting. We are underwriting our stabilized, unlevered yields, which is basically a cap rate, to about 75 to 100 basis points higher than the competition out there, higher than the actual marketplace, I should say. So we believe that our regular cash-on-cash yields for an unlevered basis is probably anywhere from 7 to 9%. So very similar to traditional multifamily. We're seeing cap rates on exits now. We are seeing transactions happening at very similar cap rates to where multifamily is transacting right now. So the market is really, again, educating itself on the stability of this product type. And because of that reason, because the market sees it as a stable market or a product type, we're seeing cap rates being very competitive with traditional stacked flat multifamily type of products. So again, overall returns net to LP were in the mid-teens to high teens, and we're seeing average annual yields in the high single-digit numbers. Question, what's the minimum required rent/occupancy levels in order to break even, considering all debt and financial obligations? So very similar, again, underwriting it to multifamily standards. We're seeing numbers in the low 80% as far as break even on a cash-on-cash basis. But right now in the marketplace, we're seeing this product type is outperforming traditional multifamily occupancies. Traditional multifamily occupancies are performing really well right now, higher than 95%, and we're seeing this product type outperform that right now in the current marketplace. How much cost over, sorry, and these are two questions from, I'm not sure how to state the name, but I'm just answering the questions that they're asking. These are good questions. How much cost overruns has PEG experienced on its current new development projects in the face of high materials and labor costs? How is PEG mitigating this risk in the BFR project? So another great question, and it's really relevant to today, right? How are we experiencing right now cost overruns, and what are we doing to mitigate those cost overruns? So one thing is we are seeing cost overruns. We are adjusting our underwriting methodologies to ensure that our contingencies are high enough to account for these. We are working with trusted building partners, whether it's internally or externally, who we believe have a good track record and who are capable of doing this. We have in-house construction management as well that can evaluate that. So we are evaluating their cost structure, everything else that they're doing in order to mitigate their cost overruns. And we are also working on, well, in every contract that we've done with contractors, the type of contract that we put together, which is a gross maximum price contract, helps mitigate those cost overruns. Now, there will be times when change orders and those kind of things will have to occur. But we do bid out and finalize our construction contract, our construction loan agreement, and our operating agreements at right before construction starts. So hopefully that helps answer your question there. Let's see, a minimum required rent occupancy levels in order to pay the 8% preferred return. Just an additional question beyond the first question. So that's a great question. So our occupancy levels in order to pay the 8% preferred return, you're probably talking in the low 90s. And so to get to that 8% pref, to have at least a low 90% occupancy level, I think you're at that range. When we talk about a minimum rent required, it's difficult to say, but it's really commensurate with the marketplace. And how we look at rents is when we go to underwrite a product, we will take a look at all the rents in the marketplace. And right now, to understand the rents for this type of product, we do a triangulation to a certain extent because there isn't a significant amount of competitive product in the marketplace. So we look at what's currently existing in the marketplace, if there is anything that's competitive in the nearby area. We look at multifamily attached products, so stacked flat attached product, whether it's in an urban core or even suburban. We take a look at those rents and we triangulate based on our experience on how we've seen rents fall in line. We look at those three things, and we also look at where similar type of product is selling in the current market. And if all those things kind of fit together, we're confident in the rents that we put in our underwriting. So those get reviewed by our analyst team, by our investment committee, and by myself as the chief investment officer. So there aren't any other questions that have popped up. We've had some great ones. I appreciate those questions. And I think we've hit pretty much most of the questions that we get asked on a continued basis. So, really appreciate the questions. And we're always open if you want to give us a call and ask us further questions, see materials that we're putting together, talk through our strategy even more, and talk through some of the properties and things that we're looking at and things we're putting under contract today. We'd be happy to provide you any of that additional information. So with that, I'm going to turn the time back to Allie.
Some great questions. Thank you so much, Soren, for standing by with those answers. This has been so much fun to be out here in this space. Hopefully the future site of one of the first build for rent communities in the Mountain West. It has been fun to be with all of you, and we do want to thank our market experts for joining us as well.
No, very much. We really appreciate all your time. We appreciate the questions. We are super excited, and we look forward to engaging in discussions with many of you. And thank you so much for joining. Have a great day.